So, hello everyone, hope you're doing all right. Today, a Zoom session. I want to go over a few things. First thing I want to go over is low probability conditions and high probability conditions. So let's dive right into it. As I've mentioned as well, today is FOMC and the pre-NFP thing. And those are days I don't trade. Now, for me, they are low probability. Why are they low probability? Well, I generally lose more trades in the London session when there is a news like this. And that's something I've noticed through data, etc. And that's just something I've picked up on. Now, again, for you, it might not be a low probability condition. But again, just because there's a winning trade on a day like this doesn't mean it's a high probability day. And that's where a lot of people go wrong, in my opinion. They are trying to trade every day. And of course, as traders, the mindset a lot of people, a lot of beginners have is trading every day. You should trade every day. No, trading, and especially when you're a bit more professional, is knowing when to trade. That's the most important thing, knowing when to trade. Now, let's say we have an 80% win rate on a normal high probability day. So on a Tuesday, no crazy news, etc., we have 80% win rate. Now, on these low probability days, for example, today for me, there's still a chance I will win. 100%, there's still a chance. The win rate might be something like 40%. So there's still a chance. But keep in mind, when you do step into the live market, you are risking your capital. Your capital is at risk. Every time you open a trade, your capital is at risk. And that's something, of course, on a 10K funded, no one really gives a shit. But when you are getting more capital, you're getting investors, this is something to think about. Would you take a trade? And that's a lot of people, they miss this mindset. There's a great mindset trick. Would you trade this day if you had $1 million capital? Would you trade it? And then your whole mindset shifts. If it was a 10K account, you're like, oh yeah, let's just do it. This 10K account, you need to, and even a demo account, you need to treat it like it's a 1 million account. Building those unhealthy habits of trading on a low probability day, for you, an established low probability day. I'm not telling you what you should do or not do, but what you establish, that's a low probability day for you. Don't trade those days. Stay disciplined, stay on the sideline. Building those unhealthy habits, for example, having a little bit of fun and just executing on NFP on a demo account. No, don't do it. And I'm talking from experience. These unhealthy habits will go from demo, and then you're trading a funded and you think, well, on my demo, it worked. So why not do it on a live account? And those unhealthy habits will transfer to your live account as well. Hello, Ben. Hope you're doing all right. All right. So I have a few conditions right here, and you can write them with me. My low probability conditions, and these are in the journal as well, in the trading dashboard. If you go to the journal, add a new day, those are my own low probability conditions, so you can check them out. Low probability conditions, a decoupled market. A decoupled market is a market that's not moving in sync. So actually the past few weeks, we've seen a decoupled market. We've seen dollar rallying higher, whilst the bonds are also rallying higher. That's a decoupled market. Those are a market, and generally you can still find winning trades. That's not the thing I'm saying here. It's not that a low probability condition is there's no trade at all. Yes, there is a trade, but it might seem very good on paper, the trade. You still have your ST, you have your order flow, you have your entry, but there's underlying things that are just not, they are not right. And understanding that win rate differential from 80% win rate, you go down to a 40% win rate. And yes, you might still win, but please, if the odds are not in your favor, and the odds aren't in your favor on the day because there's a 60% you will lose. Now, then it's just a matter of logical thinking, in my opinion, and it's a no-brainer to just stay out and just stay patient, because there are way better days to risk your capital. And that's what it all comes down to. There's way better days to risk your money. There's money on the line every time you press buy or sell. Money is at risk, and not only 1%, because some crazy shit can happen and there can be a black swan event, and every time you open a trade, you are at risk. So that's something to think about. So a decoupled market. If correlated markets are not moving in sync, so bonds are moving higher, dollars moving lower, that's the normal market conditions. If dollar is moving higher, bonds are moving higher, a decoupled market. This could be the same for ES is moving higher, NASDAQ is moving lower, etc., etc. Just because we can't get to a great higher time frame drawn liquidity. If the bonds are moving higher, dollar is moving higher as well, then we get confused. We have a 50-50 bias. Then that leads me to the next low probability condition, a 50-50 bias. A 50-50 bias is, and you'll notice it pretty quick when you can't get to a bias, and you'll notice me mention it in the higher time frame analyst topic a lot, because this week was pretty much 50-50 for me, especially the past week. The past week has been 50-50 for me because dollar, like we said, dollars reached this drawn liquidity, and right now it's a bit 50-50, etc. So it's been 50-50 a lot for me. Then the next thing, seek and destroy conditions. We went over them. Seek and destroy conditions. Again, we swept liquidity. We reached the drawn liquidity. We're now stuck at, and we're finally seeing some kind of movement again. We're now stuck at 50% of the most recent range. Why? Because we have no new liquidity. We need to build in new liquidity. We just swept the buy side liquidity. We're now heading for sell side liquidity more than likely. After a higher time frame has been reached, reversal day. Now this is an interesting one. If we take a look at the daily, and I like to do this on the daily, this first day, for example, this huge up candle right here, this up candle, that is your reversal day. This is the day you are coming into your premium array on the daily. The second day is the day you want to trade. This will likely happen in somewhere in London close, etc. This will be a reversal day. A reversal day, the day that we are coming into a high time frame premium or discount array, could also be on a monthly, etc. Those are days where it's low probability. You'll see messy price action. You'll see price wick everyone out before it starts to move, and then you get the real move. So these days, the days after, that's where you want to trade. So the high probability day are these days, the day after the reversal day. All right, then the next thing is 3 big range candles in a row in the same direction. So here we have a lot of candles, big candles, same direction. And what I like to do is, if I see this on my execution pair, I like to avoid London, especially if there was a big expansion. What comes after a big expansion? Consolidation. After a consolidation, right here, for example, on the dollar, consolidation. After a consolidation, there's an expansion. So after seek and destroy conditions, after a consolidation, high probability conditions will come back into the market. Same as here, consolidation, expansion, high probability conditions. Same here. After a consolidation, high probability conditions will come back into the market. So that's why it's so important to wait. Sorry. That's why it's so important to wait. All right. And that leads me to the next thing. Be aware of trading after a big expansion. After a big expansion, especially if you're trading 2 sessions, if London was a huge expansion, either way, doesn't really matter, then New York might be a consolidation. You'll hear a lot of people say London, and this for indices mainly. As well, of course, Forex, London, big expansion, New York will likely be consolidation. But for indices, you have London, big expansion, you have AM, New York, and that's why you'll see equities open might be consolidation, because London finished the high or low resistance liquidity run. AM session makes new liquidity. PM session makes another move. Expansion, consolidation, expansion. All right. Then ahead of NFP, CPI, and FOMC, those are the big three that I like to avoid. So the day ahead, and especially for me, the London session ahead of NFP, CPI, and FOMC. Now you can even say, because that's what a lot of people do, is stop trading after the London session on Wednesday if it's NFP week. So then you avoid the New York session on Wednesday, you avoid Thursday totally, and you avoid Friday. Now, this is something that's dependent on your data. I like to still trade on Thursday. So tomorrow is still a tradable day for me, but on Friday, I'm done. So Wednesday and Friday this week were no trading days for me. So you'll also notice I'm a little bit offline. I also had some family stuff, so some family interruptions, but that doesn't really matter. And I like to just reset a little bit because you're essentially getting a free day inside the week. So see it as a blessing in disguise. You're getting a day and a chance to reset your psychology, to reset your mental. And you'll see if you take a full day off or even a week off, this is not a bad thing to do. A lot of people will tell you when they took a week off, it's like a deload week in fitness. You have a deload week, and then afterwards you feel so strong. You feel like you can lift even more than you could before. All right, so the eighth one is Fridays when Thursday met the objective. And this is an interesting one. And let's see if I can find an example. Let me see. This is Monday. I can't really find one right now. Well, at least let's put it this way. Let's say this low was Monday. Right here, this is Monday. Then this high was on Friday. So the low was made on Monday. That's not really relevant, but the high was made on Friday. So Friday capped off the week. If Friday capped off the week, I am not sure what Monday wants to do. So if I'm not sure what Monday wants to do, I'm staying out on Monday. Now, as well, Mondays where Friday met the objective are low probability. Why? Friday met the objective. If Thursday met the objective and Friday fails to take out the high of Thursday, and vice versa, if Friday made the low of the week, or Thursday made the low of the week, sorry, and Friday failed to take out the low of Thursday, then Monday will likely be the opposite day. So it will follow Friday's trend. So I'm a little bit more certain of what Monday wants to do. And that's when you'll see me trade Monday most of the time. And that's based off of data. It was especially data on ES. So if it's also true for Forex, then check it out. All right, stuck between two PD rays on the higher time frame. Speaks for itself. If you notice, seek and destroy conditions are not only when we are stuck at 50% of the range, we are stuck between this breaker and this breaker. There's no liquidity in between. It's just a breaker and a breaker. Stuck between two breakers. That's when you'll see seek and destroy conditions most of the time. Now, for high probability conditions, clear one-sidedness. So you can only make arguments for one side. When it's so obviously, so stupidly clear, that's when there are high probability conditions. Now, these past month right here, when we came into the monthly volume imbalance, this was so stupidly clear to us that we were heading for this low. This all was high probability conditions. Same, the next one is the day after a reversal day from a higher time frame PD ray. So we talked about the reversal day. The reversal day is low probability. The day after, so this one, is high probability. Now, as well, the reversal day, see, candle signs, rejection, next days are high probability. All right, so those are a little bit of my high probability and low probability. Low probabilities, again, yes, you can still win trades, but this is not a professional mindset. All right, so then I wanted to go over the homework a little bit. And the homework was, at least it was a quick quiz, a little quiz. We came into this BPR on the dollar right here, and it's showing some new signs of order flow. And that's what I like about the dollar. It's finally displacing again. Now, my question was, is dollar, does it have bearish order flow currently? And yes and no, and if no, why not? If yes, etc. Why has it bearish order flow? Now, I loved the answer. I absolutely loved the answer because most, and I think almost everyone, of course, everyone was saying something along the lines of, for me. And that's what I absolutely love about it, because I can say order flow is bearish, but for you, you might see something else, and it's about your logic. I'm not going to trade your account. If you want to trade your own account, you need your own logic. You need to form your own unique stuff. So that's why I love when people say, for me, etc., in my own logic, and then sticking to it. Absolutely lovely. Now, there's a few arguments to make here. In my opinion, order flow isn't bearish. Of course, we're going lower, but in my rules, order flow hasn't been established bearish just yet. What I need for order flow to be established bearish, I need an ST, as we know, and that's something we'll get into after, ST. And then I need some sort of retracement into a premium ray, and then a new displacement, a new fair value gap, and then order flow is established bearish for me. Now, you could also make the argument that these wicks, we had a wick back into the breaker right here, had a new displacement lower now. That's a very aggressive view on order flow. So these wicks, we came below the breaker, we had a wick back into the breaker and already had a new displacement lower here. But that's a very aggressive way of looking at order flow. But again, if that works for you, then yeah, that's great. So that's my view on it. I don't view order flow as bearish just yet. Now, and this is where it gets a little bit tricky, right? For me, the arguments to go lower on dollar are stronger than to go higher. But I'm not 100% sure, because there is, on both sides of the market, no established order flow just yet. So for FOMC, if you are looking at doing the exercise, the higher time from analyst exercise, if we do have FOMC, it's a great way to practice. Now, hopefully FOMC will not be disappointing and it will actually have a lot of volatility. Then I would look at something like this, an aggressive, and that's important, aggressive spike higher, a big rejection, and then a continuation lower. Why an aggressive spike higher? An aggressive spike higher is just like the ST. An aggressive spike higher is a Judas swing, etc. It's your market maker model. An aggressive spike higher is that enticement of retail traders, etc., to get into the market and thinking, oh, this thing is going higher, and then going lower. Boom. That would be my thought process on the dollar right now. But again, since there is no established order flow, it might just do something like this. I'm not sure. And it's also the reason why we stay out, because we only have to be wrong once on FOMC, and we are absolutely, I don't want to say a lot of bad words, but we are absolutely fucked in a sense, because there's no risk management involved, and being wrong once will have a big impact on your account. So that's why we don't ever. And that's exactly why we don't trade it. All right, so ST examples. A lot of great questions in the Discord as well on STs. And I want to answer them as well right now. And there's a difference between an ST and a BPR. A BPR, as we know it, is, for example, this, or for example, this. I mentioned this in a BPR. A BPR is a clear overlapping fair value gaps. So a BISI and a SIBI, and it's perfectly overlapping. This is also an ST, but there's a difference, a minor difference between an ST and a BPR. An ST, first of all, we need context behind an ST. Not everywhere is an ST. If we are not coming off of a PD array, it's not an ST. So first off, we need to come off of a PD array to make it an ST. Then the next thing is we need, if let's say it's a premium array. We need a premium array. Then the next thing is we need a BISI. So we need momentum going into the premium array. Why is this? And then if you know the reason behind it, it might make more sense. If we need a BISI coming into the premium array, it's the same thing as I just mentioned on news. We are enticing opposite. In this case, we are enticing buyers to then match them with sell orders. So if we are enticing right here, a big spike up, we're enticing buyers. For every buyer, there needs to be a seller. So how can we get buyers into the market in the most efficient way? Playing with their emotions, enticing them into the market. And I'm sure we've all been there. And I know I've been there, especially when I saw a big move up like this up candle right here. I thought this thing is going higher. I want to buy. And that's exactly why price is doing it, right? So they trick me. So they're doing a really good job at it. And then you see it come into a premium array. And if you're unaware of the premium arrays, then you're getting blindsided. So enticement, tricking buyers, matching those buy orders with sell orders right here. So what do we need coming out of it? We need an aggressive move lower. The only way we can look at an aggressive move higher and aggressive move lower is by measuring it with some value. So we need to have some objective rules on it. Now an ST is not 100% objective. I'll give you that, but it's not hard to spot an ST. A BISI, a fair value gap, a bullish fair value gap, a SIBI, a bearish fair value gap. Those are the two signs of displacement for me. So essentially we're having displacement into the premium array. And this will be scary at first, because at first you're like, displacement into the premium array? Are you crazy? We need it out only, not in. No, we need it in as well, into the premium array, and then a displacement out of the premium array. Now, this is where things get a little bit interesting, and this is where your own practice and your own deep work sessions get involved. Because this right here, for me, would also be an ST. Yes, there's no BISI, there's no SIBI. But to completely neglect that this is not an ST, that's, in my opinion, foolish. There's two candles, a big up candle coming into it and a big down candle coming out of it. Now, if we had these two candles completely separated, we would have two BISIs, we would have a BISI and a SIBI. But just because there's one candle missing in between doesn't make it an ST. So that doesn't really make sense for me. Now, this right here, this move up, and then this volume imbalance is also an ST for me. So if there's a BISI on one side and a volume imbalance on the other side, it's also an ST for me. And the volume imbalance could have also been here and then fair value gap here. Completely fine for me. It's just about the context behind it. We need some measurement of displacement. That's the most important thing. And displacement is not that hard and not that hard to see. So an ST, and I call them ugly ST. This is an ugly ST. This is a picture perfect ST, but this is also BPR. And that's when you'll see a BPR is an ST, but a BPR doesn't always have to be an ST. An ST is not always a BPR. This also an ST, obviously a very picture perfect clean ST. Now I've noted down some examples as well to take a look at some ugly STs. DXY the 14th of February is the thing I noted. Let me right here somewhere. Yeah, this one. This, so if we had this low, for example, we had this low, this volume imbalance down, then this fair value gap away. They are not really overlapping, right? At least there's some candles in between right here. This is still an ST for me. They don't have to be completely perfect overlapping. It's just about displacement down. So you need to have a little bit of a view. Are we enticing sellers right here? Yes. Are we now displacing higher? Yes. ST. And then again, first discount array, enticement in, enticement out. Or enticement in, sorry, displacement out. Then I also had on EU, the 4-hour. Let me take a look. EU, the 4-hour. I don't have a date for it. So let's, I think it was this one. Let's take this one. This one right here. If, wait, give me 2 seconds. Sorry, bell was ringing. All right, so ST. If we had some sort of discount array right here, so we had this low, for example, there's not a real clean discount array here, but let's just say there was. Then we had this enticement going into it and this displacement going out of it. Now, let me catch my breath. This would also be an ST for me. So I hope that clears a lot of it up. And it's mainly about, and this is where your own work comes in. It's mainly about seeing that enticement in and displacement out. So every low and high in the market is a great way to analyze it. How to use ST without needing, oh yeah, great question, almost forgot it. That's why I wrote 4-hour EU actually, because I saw it right here. Let me see. Yeah. Where did I see it? I think I saw it here. So because we are using ST, right? We are using essentially the enticement in, displacement out. If we take a look at this lag here, let's say hypothetically we are coming into a 4-hour discount array here or whatever discount. We could even use this right here. Let's say we are coming into a discount array here. Then this right here, this ST, this is a perfect BPR. So this is an ST, enticement in, displacement out. This right here could also be your entry on the fair value gap right here. So as you can see, you don't need a market structure shift then. If we take this one right here, coming into a discount array, let's say this is a higher time frame discount array. Right here, coming into it with enticement. And this is generally how lows and highs are formed in the market. And this is how I actually got to the ST. They are always, lows and highs of the market are 99% of the time are, it's first an enticement and then a displacement away. Enticement, displacement away. So if we know that, we can have an enticement, a displacement, this fair value gap without the market structure shift could already be our entry. It's a very early, it's a very aggressive entry, but it could be your entry already. Now, that leads me to the next thing. Let's say for Dameson, man. Once you see it, you can't unsee it. I should start talking in riddles as well now on Twitter. Fancy stuff. All right. So that leads me to the next thing. I think there was one on, where was it actually? Now, yeah, let me take dollar, for example. Let's say we are coming off of the premium array, which we are. This premium array, and let's say we wanted to execute on a dollar. And we already had our ST. Right here, we have an ST. Then that first order flow switch, or that first market structure shift. Let me see. I think there was an example right here. Yeah, this was perfect. So right here, you could argue we have a little market structure shift here, but let's just say we didn't. All right. So we're coming off of the monthly premium array. That's important for you to acknowledge. We're coming off of a monthly premium array. A monthly, that's a very strong premium array. So there's a lot of orders behind it. Here, we get an ST, a BISI, and a SIBI. This right here could already be a very early aggressive entry. Because first we have our monthly is supporting us. So that's a big, higher time frame and a lot of orders behind it. Then we have a 4-hour ST. And then we need a 5-minute ST, a re. There's a lot of things for us going in our favor, essentially. So in that case, and same as here, for example, right here, we called this actually in last month, I believe, this price action. We were coming off of a daily discount array, daily order block, if I remember correctly. And we had this right here. This could already be your entry. So let's go over this entry actually. Yeah, I think I took an entry as well here. Right here. So because we already coming off of a higher time frame discount array, then we have an ST, we have the enticement, we have the displacement away, and then here we already can see a 5-minute as well, a 5-minute ST, 5-minute enticement in, displacement away. There's so much things going in our favor right now. So this right here, either this could be your entry on the breaker. You could refine it down to the fair value gap. Again, that's completely what you prefer. Now, for the respect of the breaker or respect of the ST, right here, this is your ST, right? Now, for it to be respected, we need a new displacement away. What's a new displacement? It's a new fair value gap in our favor. This is a new fair value gap, and that's why you'll see a lot of the time, this is my bread and butter. Once this ST gets respected, you have your re-entry. This re-entry gets confirmed once the fair value gap gets confirmed. When I say confirmed, I mean it's officially formed. So this fair value gap is officially formed once this down candle is closed. So a lot of the times, I don't even wait for that fair value gap to be traded into. Now, of course, if you prefer that, then you could obviously do that. But can you say that again? Yeah, sure. I'll go over it again after this. So this, again, the fair value gap doesn't need to be traded back into for me. So I like to enter as soon as this candle closes, boom, that's my entry, cover the breaker. This was my exact entry as well. And I targeted this high. That was my exact entry. And to tell you again, we're coming off of this 4-hour, again, daily order block, 4-hour ST, not a market structure shift on the 4-hour yet, but we already have a daily discount array we're coming off of. Right here, we came off of this daily order block. We're targeting this monthly SIBI, 4-hour ST. That's already a lot of things going on for us. Then right here, in the 4-hour ST, this fair value gap, we have a 5-minute ST. So the enticement in, the displacement away. Now we have a market structure shift. The market structure shift is not mandatory. It doesn't have to be a market structure shift for there to be an ST. Now, next thing, if we want for the re-entry, so for the third entry option, we need the ST to get respected. And respect, the definition of respect is a displacement away. So that's the first thing. For the definition of respect, of something getting respected, is a displacement away. Now, the definition of a displacement away is a fair value gap. So you can see that that's sort of like the thing. ST, respect, is displacement. Displacement is FVG. Just to make it, that's to make it a little bit objective, right? There's simple steps to follow. So you have the ST, the enticement in, the displacement out, and you can, everything can be made into very small and simple structured steps. So the ST is a discount array, an enticement in, a displacement out. Then the respect, so the respect of an ST is a new displacement away from the ST. So right here, we have a breaker, a fair value gap. That's the ST. If we need to see respect, a new displacement is a new fair value gap away from this ST. It doesn't have to come entirely into the ST. It can come into the breaker, into some sort of discount array that's overlapping with the ST. As long as it's coming back into a discount array, and I like to see one down closed candle, again, doesn't have to be, like we talked about at the beginning on the dollar. Then I like to see a new displacement, a new fair value gap away from it. As soon as this fair value gap, this displacement gets confirmed, so this fair value gap gets confirmed after this candle closes, that's already my re-entry. So my entry would be on this exact candle right here. And for me, it doesn't have to be, or it doesn't have to come into the fair value gap. So it doesn't have to come into fair value gap for me to enter. I just want to get in because our work is essentially done on the higher time frame. So I just need to get in essentially. Let me take a look at this as well. All right. Just answered my question on missing the FVG entry or it not going into the FVG. Just look for the 2 displacement confirmed, correct? Just answered my question on missing the FVG entry or it not going into the FVG. Just look for the 2 displacement confirmed. Yeah, exactly. Yeah. And the thing is also why I also like to do that, because sometimes, and not every time, a lot of times FVGs will get traded back into. It's just a preference. But for example, here, you already have your breaker overlapping and the first line of defense right here is your order block, the open of the order block. First line of defense here is your breaker. First line of defense here is your breaker. Sometimes it will not sting back into the fair value gap. And a lot of times when that happens is because there's already a premium or discount array holding price. So for example, here, there's a breaker holding price already. So it might not come back into the fair value gap. So that's why I like to enter on the higher discount or premium array. That's the first line of defense. This breaker is the first line of defense. Why? It's the first discount array that price will encounter when it's retracing. So the second one is a fair value gap. The third one is this fair value gap. Now you can see if there's 2 discount arrays holding price up, this fair value gap and this breaker, can we expect it to come into the third one? No. Can we expect it to come into the first one? Yes. Can we expect it to come into the second one? Maybe. So there's a yes, maybe, no. And that's your probability of entering, essentially. Here, there's this BPR would be the third one. So with this fair value gap, this BPR, and this breaker. First line of defense is this breaker. Breaker is the yes. Fair value gap is the maybe. BPR is the no, essentially. And that's how you might miss entry. So because our work is done on the higher time frame, I want to get in, essentially. I want to capitalize on it. So I just want to get in, even if I enter here or here, doesn't really matter for me. I just want to get in. I want my hard work to be paid off, essentially. Do you have to see an ST on the 4-hour first? You don't, but generally it will happen. But in this case, it was because on the 4-hour we came into this order block, this daily order block. Then we came into and we exploded higher. So everything in here would be a 15-minute entry for me. Daily order block, 15-minute entry. The next thing, we came into this 4-hour premium. Remember discount premium. So once we came into this premium, we already had a lot of expansion here. So I told everyone in this price action right here, we already had a lot of expansion. So I would want to see a new 4-hour or a new higher time frame, and that's a 4-hour, everything 4-hour and above, discount array for me to start looking for entries. Now, a lot of things that we prevent with this, because a lot of people right here will see this. They will see London expansion, and they will just scout for entries on a 5-minute. Now, you might have gotten to the same entry, but I know some people also took this entry. So you already took an unnecessary loss because you're just scouting for entries on the lower time frame. We avoided that by knowing it's now in a short-term premium, a short-term order block. It's a short-term premium. Maybe we will see some retracement. If we see a retracement, we will get into the 4-hour discount array and then look for entries. Now, to answer your question, do we need an ST on the 4-hour first? It's all fractal, essentially. So for our order flow, we will see 4-hour STs. And coming off of this monthly, etc., we don't, how do I say this best? We don't need it, but it will happen, if that makes sense. So for example, here, we're coming off of this ST, this BPR, then we have a new ST here. If order flow is in our favor, it will automatically have an ST, if that makes sense. So do we need it? A lot of time we already have it in our favor for 4-hour order flow. For example, right here, we already can make an argument for enticement displacement away. All right, so those were the things I wanted to talk about mainly. If you do have other questions, then let me know and I'll go over them right now. In about 15 minutes FOMC. Interesting. What would happen on FOMC? Can take a look at Australian dollar as well, right here. Australian dollar, like I said, if we do want to continue lower, I wanted to see it continue lower off of here and disrespect this discount rate. For now, it's just, it seems like we are establishing a bullish order flow. When you mean ST gets respected, you mean it touches it? Yeah, great question as well. Let me go over there right here. And moves away. Yeah, so essentially, when ST gets respected, like for example, this would be your official ST, right? This enticement in and this displacement out. Now, for ST to get respected, we just need this ST. Then what is the next discount array we are coming off of? So we have this breaker currently, and then we have this fair value gap. It needs to trade into one of those two. So it needs to trade back into some sort of discount array. That can be any discount array. And then we need to have a new displacement away. So that new fair value gap away. So if we take a look at the dollar, actually, that's a perfect example right now. That's why I said order flow hasn't been established bearish for me just yet. Why not? We have this breaker right here, the first one. Then we have another one right here. We haven't really seen a significant move. So one 4-hour candle at least, one 4-hour up candle at least, coming back into some sort of premium array, and then a new fair value gap away. So it doesn't have to come into the ST perfectly, as long as it comes into some sort of premium array, the premium array that forms, and then move away again. So if we have another example right here, for example, this would be your, oh, don't let me, yeah. For example, this would be your ST, this essentially, this gap, etc. We don't have to come back into here, all the way in here to respect the ST essentially. All we need now is a new displacement away. So we have some sort of displacement here, and then we have a displacement here coming off of a new premium array, this fair value gap and this breaker. So I hope that makes sense. So you said if it comes into the daily, you would enter off of 15. Is it okay to align daily 4 hour and then 5 minutes for entry? Or should I take anything else into consolidation? Is it okay to align daily 4 hour and then 5 minutes for entry? Or should I take anything else into consideration? No, that's perfectly fine. That's absolutely fine. That's perfect. Then you have a lot of things going for you. That's absolutely perfect. So then you would have the daily 4 hour, and then off of that 4 hour, you would enter on a 5 minute. So yeah, that's perfect. So what I would do is you have this daily, then here 15 minutes. So daily order block 15 minutes. Then the 4 hour also aligns. So then here I would do on the 5 minutes essentially. So all we need, all what we need for an ST is one both sides FVG or one side FVG and other volume events, right? Yeah, perfect. That's absolutely perfect how you said it. So all we need is that, but the most important thing is the enticement. How can we objectify enticement or displacement, a volume imbalance or a fair value gap? So we need fair value gaps on both sides, or one side fair value gap and the other side volume imbalance. Now, I know in the past there was someone in the mentorship that was trading Nifty. If we take a look at Nifty, and that's exactly the reason why I tell people one fair value gap at least. If we take a look at Nifty, which one was it? There's a lot of gaps, and I mean a lot of gaps. So in here, an ST will always have gaps, essentially. So that's why I tell people at least one fair value gap and then a volume imbalance, because the definition essentially for an enticement or displacement, enticement is the same as displacement. So displacement, definition of displacement is either a volume imbalance or a fair value gap, essentially, if that makes sense. All right. So nobody trading FOMC, right? Nobody's blowing accounts. Come on. Let's take a look. I was looking at, yeah, Australian dollar, right? Yeah, Australian dollar. Let's take a look. But I do 100 contracts both sides for sure. Come on, man. Come on. There are people, you will see people during NFP, and it happens a lot actually on Twitter. You will see people that just brag about catching the NFP stuff and the FOMC stuff. There are people legitimately just happy about catching this stuff, and I don't tell them anything, or I just let them be happy. But one day it will absolutely mess you up, and it's a one-way ticket. Took a short of MCL earlier today, but not in market in the moment. Nice. Good stuff. All right. For Australian Canadian dollar, again, this is exactly the reason why I don't like to trade FOMC ahead of end of FOMC, etc. This typical price action where it just consolidates and not really moves. Now on the lower time frame, again, every little thing on the lower time frame will always look clean. Everything on the lower time frame will always look clean. Why? There's just, if volatility is taking over, you'll see it on the lower time frame. There's always volatility on the lower time frame. Now it might differ a little bit, but on the higher time frame, we can see This is pretty clean, right? We have this displaced in the way. We have this return displaced in the way. Well, maybe we could enter right here. A higher time frame is just consolidating. So that's why lower time frame is always clean and will always be clean. That doesn't mean you trade it. All right. Perfect. This is looking pretty cool. If Australian dollar does want to continue lower, we have this breaker right here. We have a huge BPR right here, big ST. Breaker overlapping with the fair value gap, something like this would be pretty cool. Australian dollar, US dollar. This is looking currently like it wants to do the exact opposite. So wants to do something like this. And then GBP, Australian dollar. This is a little bit in between. We did close in this potential fair value gap. So that's what happens a lot of the time. Sometimes price will already close in a fair value gap ahead of it actually forming. So if it does want to continue higher, this order block, boom, right here, and then take out the high to the left right here. That would be pretty nice. So again, Australian dollar, GBP will also be affected by FOMC and by NFP because US dollar is obviously the world reserve currency. So the whole world is currently based off of the dollar. Basically, it's the largest currency, the largest economy. Now, will that change in the future? It might. I heard we got a new changing world order. So who knows? The Chinese yen might take over. All right. Euro USD consolidation right here. It is displacing up again. So it's interesting to see. All right, let me end it with the dollar. Again, dollar bearish arguments are currently stronger than the bullish arguments. So that's something to take a look at. Curious to see what happens if BRICS currency or whatever will mess things up bad enough to keep track of DXY. Yeah, exactly. Yeah, and also very currency about what is it? The CBDC, the central bank digital currency. They are already out there in China, etc. They already have a central bank digital currency. Very interesting to see what will happen. And if you are interested, you can check that out on BIS. That's the biggest, the central banks of the central banks. It's called BIS. It's basically what everything runs. Thanks, sir. I have to go. Thank you for being here. See you later. All right. I'll see everyone later. Thank you for being here. And I'll check you all in the Discord as well. And stay out of FOMC and stay out of NLP. I'm watching you all. All right. Thank you, everybody. Thank you. Bye-bye.